Hello everyone, welcome to today's US Open live webinar. We're 10 minutes out of the opening of the US markets. This is your host Nikos Zabouras, Senior Market Specialist at FXCM, and today it is Thursday, December the 8th. Now, this week we have seen choppy price action and price action that is a little bit hard to explain, but overall we've seen risk-off mood. However, sentiment shows improvement today with Wall Street up and the US dollar lower. But before we go ahead and talk about today's events and the technical outlook, as always, please read carefully through the disclaimers and the risk warnings, and then we'll get started. Once again, please read carefully the disclaimers, and we'll get the ball rolling. Okay, so let's go ahead. As we look at the Euro USD chart, let's go through the main developments since our last sessions and over the last few days. So as we said, there is choppy price action, which is not exactly easy to explain. Stock markets had jumped after Powell's speech last week, but this week they actually dropped after a series of strong US data. So we're again in this environment where good news is bad news for Wall Street and vice versa. Because of this strong data, markets reassessed the Fed's tightening path, and they fear that it will keep at it, let's say, keep tightening, and this could spark a recession. That seems to be the prevalent mood over the last few days. Now, another thing that is probably not very easy to explain is that markets and stock markets had actually rallied on hopes of China reopening, but now that we are actually seeing an easing of the strict lockdown measures there for the pandemic, they don't seem to be able to benefit. Of course, one needs to be mindful of the fact that even though we are seeing a moderation, a softening, let's say, of the zero COVID policy, infections are very high, and recent trade data from China earlier in the week disappointed because exports and imports both contracted by the most since early 2020, and this actually shows the effect of the pandemic disruptions. Now, and of course, we need to see whether this reopening, let's say, will actually backfire or will be able to put China on a better, let's say, socioeconomic path. Now, another news, we had the Bank of Canada raising rates by 50 basis points as expected on Wednesday. The central bank has been slowing the pace of hikes since the peak with a full percentage point move in July. And what was more interesting is that it has now opened the door to a pause of tightening, as it said that the governing council will be considering whether the policy interest rate needs to rise further. So essentially, they open the door to a pause, the first major central bank, Bank of Canada, to essentially open the door to such a scenario whereas other banks are looking to slow down or have already slowed down, such as the RBA, their tightening cycle. So that is pretty much it from recent developments. As we said today, Wall Street rebounds after a 5-day decline, and the US dollar is facing pressure. So now let's go ahead at the technical outlook, and we have Euro USD here. So Euro USD is having a mixed week as it tries to cover the losses of the first half of the week. And the technical outlook has not changed much from our last analysis. The common currency maintains a positive tilt and has the ability to push for fresh 5-month highs to 1.0609, this resistance that we have highlighted in previous analysis too. But we can say that it does inspire much confidence for tackling the next major resistance at 1.0727. On the other hand, the poor start to the week has created risk of a slide towards the 200 days EMA, although a catalyst is probably going to be required for that, and further weakness towards 1.0289 does not look easy at this stage. In any case, direction may be hard to find. The pair may be hard to find direction ahead of next week's busy calendar, which is highlighted by the Fed and the ECB rate decisions, but we'll get more to it next week. So that's it for Euro USD. Again, not much change from our previous analysis. Let's go and move on to gold. We haven't touched on gold for a few sessions now, so let's go ahead and do it now. We are the 4-hour chart here. So gold plunged at the start of the week, but covers much of those losses since then and retains control, while the relative strength index, which we can see here, we have highlighted it, is in constructive territory. So from here we can see higher highs. Current highs are at 1,810, although we are unconvinced at this stage for its ability to post sustained strength past 1,842. Monday slump, however, has created risk for a test of the 200 period EMA, the black line here, located at around 1,738, but it will probably require a strong catalyst for daily closes below this level that would shift bias to the downside and would bring 1,682 in the spotlight, but this looks hard in the near term. And again, a catalyst will be needed for a test and a break below the EMA 200 that we talked about. And let's also take a look at oil. So here we have oil. On Tuesday, we had talked of the risk for testing the 200-week EMA, which is here, and this actually happened since then. And this also was accompanied by fresh 2022 lows. However, we have maintained for quite a while that sustained weakness below this level has a higher degree of difficulty, and we can see that it defends this support today. Of course, we have highlighted here a jump that we saw a little bit earlier, and that is, other than the technical aspect of it, it's because of some news, and in particular news that TC Energy, who is the owner of the Keystone pipeline which connects the US and Canada, actually shut down the pipeline due to an oil leak. So this jump that we see was a reaction to that news. However, it doesn't look like this move has legs, and we could see a return and a return above the 200 period EMA around here still looks strong. It's probably hard. Sorry, it's probably gonna be elusive in the near term. We're talking about the broader 82, 83.3 region. In any case, bias remains on the downside, and US oil is vulnerable to the next support of 67.11. But again, we see hard to we don't see prospects of sustained weakness below these levels because China reopening story could help. OPEC, we discussed on Tuesday that they did not deepen their cuts, but they already ran a massive production cut program and have shown their willingness to adjust. So that's it for US oil, and let's round things off with SPX 500, the broader US index, as we're now at the point where Wall Street opens. Let's move to SPX 500. Here we are. So the index is having a bad week. It breached the 200 days EMA, as we had warned on Tuesday. This exposes it to the 3,870 region here, which is the 38.2% Fibonacci of the advance from the October lows to the December highs. But we will need to see some catalyst for this level to be breached and expose SPX 500 to 50% Fibonacci around here. Now, the index finds support today and tries to end its 5 days losing streak, and it does have the ability to reclaim the 4K handle, the 4,000 here. But again, we will need to see some impressive improvement in sentiment for it to challenge the descending trend line from the record highs at around 4,100, around this area. So as we said, it's a bad week for Wall Street, but it does, but SPX 500 finds reprieve today, and above the 200 period EMA here, the black line, it does have the ability to push higher. Now, that's pretty much it from the technical outlook, and we'll end today's webinar with what's ahead. It's a light calendar ahead for the week. We expect CPI inflation from the consumer inflation from China and factory gate inflation from the United States on Friday. But again, it's a light calendar, but next week is loaded, we would say, with many high profile events. We have CPI inflation figures from the United States and other stuff. But of course, major central banks will be in the spotlight. We have the Fed, the Bank of England, and the European Central Bank making their decisions, their interest rate decisions, to the second half of the week. But we will talk about that extensively in our US Open webinar on Tuesday before those events. Now, until then, at the start of next week, we have UK monthly GDP and jobs data from the UK, and also the US CPI inflation that we mentioned. It's on Tuesday and just a day ahead of the Fed's rate decision. Headline CPI had eased to 7.7% back in October, and it was the first sub 8% reading since February. And core inflation had moderated to 6.3%. So we saw softer inflation CPI figures, and last week we got the BCE data, which also showed a moderation in price pressures. So we'll be looking forward for those events. That's it from today's session. We'll talk again on Tuesday at 14:20 GMT, as always, 10 minutes before the US Open, and we'll cover extensively the central bank landscape ahead of these highly consequential decisions. Thank you for joining me. We'll talk on Tuesday.